If you couldn't withdraw your money from the bank or use it freely, and the bank limited you to spending only a few $100s or less at a time, could you accept that? You might think such strange rules don't exist, but they are indeed happening to people in China. They gave me a 1,000 yuan limit. How am I supposed to transfer money? This is too troublesome. I only use this bank because it's close to home. If it were far, I wouldn't keep my money here. The woman in the video is a business owner. The bank limited her to transferring only 1,000 yuan, 137 US dollars, per transaction, which disrupted her business. In another video, a woman desperately seeks money for a medical emergency but can't withdraw it due to the bank's limit. She waited for over an hour without getting the money, becoming increasingly distressed and crying, "You're going to kill my sister. I urgently need this money to save her." Some viewers questioned why the woman insisted on withdrawing cash instead of using other payment methods. They also noted that she was at a housing fund window, possibly trying to withdraw funds for medical expenses. Others explained that sometimes people use special service windows for general transactions due to the long lines at other windows. Another woman expressed her frustration in a video. "This is my card, my money. I asked to adjust the limit, but they said no. Then I asked to withdraw money, and they told me I couldn't without an appointment." This woman found that her account with tens of thousands of yuan had a transfer limit reduced to 5,000 yuan without her knowledge. When she urgently needed 200,000 yuan, she couldn't transfer it. She then tried to withdraw 150,000 yuan, but was told she couldn't do so without an appointment. These incidents of bank accounts being unexpectedly frozen or having their transfer limits reduced have become common in China. Many people share their experiences online, leading to heated discussions on this issue. Mr. Su from Shanghai faced a similar problem. His salary card's daily transfer limit was reduced to 500 yuan without prior notice. When he called the bank, they explained it was to protect his funds and prevent fraud. Mr. Su said, "I've seen this with other less used cards, but my salary card is used frequently. I need to pay my mortgage soon and don't understand why the bank would limit my account without informing me. What if I urgently need money?" Mr. Su couldn't understand the bank's limit. Ms. Wang in Beijing faced a similar situation. When she needed to repay her consumer loan, she discovered that her bank account's transfer limit had been reduced. She could only transfer 5,000 yuan per transaction, with a daily limit of 20,000 yuan. She said, "Because I couldn't transfer the money from my account, my loan almost went overdue. This limit is really causing problems." From online feedback, this issue is becoming widespread across the country. There are even concerns that withdrawing your own money might soon be considered illegal. According to a report from the China Securities Journal, on July 12th, several banks from Zhejiang, Shandong, Shanxi, Hebei, Liaoning, and Guizhou announced that they would lower the transaction limits for some customers' non-counter transactions starting in July. The bank stated the reason for lowering the limits is to enhance personal bank account management, reduce the risk of customer funds being lost, and comply with regulatory requirements for categorized management of personal bank accounts. The Securities Daily also confirmed this, mentioning that since the beginning of the year, banks such as the Bank of China, Huaxia Bank, and Jiangsu Bank have adjusted the payment transaction limits for non-counter channels. The reason for the adjustment is to combat telecom fraud. A netizen visited various banks in China asking about their limit standards and recording the responses. A Bank of China employee said the maximum transfer via mobile is 1 million yuan, but a new card can only transfer 500 yuan and can only increase the limit after 6 months. The Bank of Communications said that for a new card, the initial transfer limit is 3,000 yuan with no counter limit. The Tai'an Bank stated that the limit depends on the user's transaction history and could be around 5,000 yuan per day. The Agricultural Bank of China mentioned that each person's limit is different, with the minimum being 0, meaning no transfers allowed. One netizen criticized, "The bank is the biggest robber. My money is controlled by the bank, not me. It's ridiculous." Recently, many parents couldn't pay their children's school fees due to these limits. They had to withdraw cash from the bank, but were stopped after 2,000 yuan. The bank said it was a temporary limit and to come back the next day. If you don't use your card for a while, you might not even be able to transfer 2,000 yuan. Many banks now have a daily transaction limit of 5,000 yuan. If you don't face any emergencies, it's fine. But if you need to pay for your child's education, a house down payment, or an urgent hospital admission, what can you do? I have to go through a lengthy process, fill out forms explaining why I need the money, and bring various documents to prove my identity. This takes too much time and is very inconvenient for regular users. A financial blogger commented that this is just banks playing dirty tricks. She said, Look at the banks since July. Some have a limit of 5,000 or 10,000 yuan, and others have a limit of 1,000 to 3,000 yuan. Previously, transferring 50,000 or 100,000 yuan was as simple as snapping your fingers. Now, if you need 100,000 yuan for an emergency, the bank will tell you to wait 20 days. The rule of customers having free access to their deposits hasn't been abolished, so where's our freedom? The banks are breaching the agreement. Is that fair? Nowadays, banks are shameless. Your money is in their hands, and they won't let you take it out. What can you do about it? Despite the widespread complaints and criticisms online, the main concern remains, what's happening with the banks? Why is it becoming so difficult to withdraw money? According to informed sources online, the banks are running out of money. To truly understand why this issue is happening, we need to look beyond the surface and understand the fundamental mechanisms of how banks operate. Once we grasp how the Chinese financial system works, we can understand why banks are running out of money. When users transfer money, what are they actually transferring? From the user's perspective, they're transferring their deposits. From the bank's perspective, it depends on whether the transfer is within the same bank or to a different bank. Internal transfers within the same bank are straightforward, involving a simple account-to-account transfer. However, interbank transfers require the transferring bank to move its reserves held at the central bank to the receiving bank. This means that for a bank to facilitate a transfer, it also needs to have sufficient reserves. Banks, like depositors, have their own deposit accounts, including required reserves and excess reserves, similar to fixed and current deposit accounts for individuals. However, these bank accounts are held at the central bank, and transfers are made within the central bank system. The bank's required reserves and excess reserves are part of the base money, which are assets for the banks and liabilities for the central bank. So, when people say that banks are running out of money, many might laugh and say, banks have the most money, how can they be out of money? In reality, banks are often the most short of liquid cash because assets do not equate to liquidity. This can be understood through the example of Evergrande, China's infamous bankrupt property developer. Evergrande had trillions in assets, but lacked liquid cash, leading to a liquidity crisis and default. Banks have assets worth hundreds of trillions of yuan, but the actual base money reserves are only about 21 trillion yuan, with only about 3 trillion yuan in liquid excess reserves, which is just about 1% of total deposits. Banks rely on the small 1% of liquid reserves to handle massive user transactions. The commercial banking model, known as the fractional reserve system, essentially operates on leveraging, moving funds around, and maintaining low liquidity to stay profitable. If banks had to hold 100% of deposits in low-interest reserves at the central bank while paying higher interest on depositor accounts, they would lose money. Thus, banks are inherently short of liquid cash due to the nature of the commercial banking system. The current issue is that the government is issuing large amounts of debt, sometimes in the trillions. Banks are compelled to fulfill national obligations by purchasing government bonds, draining the little liquidity they have. This leaves banks without enough money to clear transactions, forcing them to limit transfers. While the central bank can inject liquidity through reverse repurchase agreements, this comes with interest costs, such as an annual interest rate of 1.8% for 7-day reverse repo. Borrowing from the central bank at this interest rate to facilitate transfers is costly for banks, so it's easier and cheaper for them to simply limit transfer amounts. The root cause of transfer restrictions is the banks running out of money after using their liquidity to purchase government bonds. Despite the central bank's efforts to replenish liquidity, the high costs involved lead banks to limit depositor transfers. This situation is a result of the real estate bubble, failing property prices, unsellable land, and the local government debt crisis. Consequently, the central government issues new debt to pay off old debt, and banks, fulfilling their national duty, use up their liquidity to buy these government bonds. This creates a domino effect, impacting everything from the central to local levels. The bursting of the real estate bubble, the collapse of credit, and the resulting financial strain on the government and banks make it difficult for ordinary people to transfer money. Ultimately, it boils down to the banks running out of money. Recently, many Chinese banks have also prematurely terminated some financial products before their maturity dates, which ties back to the same underlying issue. According to incomplete statistics, since June this year, more than 20 wealth management products have been terminated early. These wealth management products were managed by the bank's own subsidiaries and were considered quite safe, attracting a lot of investments. So why were they suddenly discontinued? The reason is simple. Continuing these products would likely result in losses, and banks want to avoid having to explain this to their clients in the future. Most of these products invest in fixed deposits, certificates of deposit, and bonds for safety. If market interest rates continue to fall, the returns on these investments will decrease, making it difficult to provide the promised returns to investors. Why has there been such a sudden and widespread discontinuation of these products recently? The key point is that interest rates are expected to continue falling. Recently, the deposit rates at small and medium-sized banks in China have been steadily decreasing. For example, on June 4th, the Lanzhou Rural Commercial Bank reduced its 3-year fixed deposit rate from 2.7% to 2.6%. On June 1st, the Chenghai Rural Commercial Bank in Guangdong lowered its 3-year fixed deposit rate to 2.2%. The Pingle Bank in Guangxi to 2.8%, and the Fuchuan Rural Commercial Bank to 2.8%. After multiple rounds of interest rate cuts over the past 2 years, it is now difficult to find fixed deposits with rates above 3%. Moreover, the trend of lowering interest rates is far from over. At the end of 2023, the net interest margin for commercial banks fell to a historic low of 1.69%. However, this was still higher than the rate in the first quarter of this year, which dropped to 1.54%. To maintain profitability and avoid collapse, commercial banks must continue to lower deposit rates. Let's look at another set of record-breaking data. Financial data from May showed that the broad money supply, M2, grew by 7% year-on-year, the lowest growth rate on record. The narrow money supply, M1, decreased by 4.2% year-on-year, marking 2 consecutive months of negative growth, also a first in recorded history. These alarming figures indicate weak loan demand from businesses and individuals, a lack of corporate expansion, and low economic vitality. To stimulate the economy, loan interest rates must be further reduced. China now shows a tendency towards Japanification of savings, reminiscent of Japan's post-bubble economy in the 1990s, where people preferred to keep their money in banks even at zero interest rates. This phenomenon is known as a liquidity trap in economics, where people prefer to save rather than spend, freezing money circulation. As a result, no matter how much money the central bank prints, businesses and households use it to pay off debts instead of spending and investing. Currently, the trend of early loan repayment in China is intensifying. In April this year, the rate of early loan repayment by residents reached a historic high of 37%. So, both deposit and loan interest rates are expected to decrease, and banks are discontinuing high-interest deposit products and high expected return wealth management products to prepare for the low-interest rate era. This era not only brings low profits for banks, but also makes it increasingly difficult to cover the gaps left by previous loans to the government, real estate companies, and private enterprises. Therefore, China is headed towards a time when people will not only earn less, but also find it challenging to spend their money. Moreover, the issue of banks running out of money has other causes, such as corruption, which creates financial holes, especially within the banking system. On July 13th this year, according to a report on the Central Commission for Discipline Inspection and National Supervisory Commission's website, Peng Jiabing, Deputy Governor of the Jiangxi branch of China Construction Bank, and Liu Yujuan, Deputy Governor of China Guangfa Bank, were both under investigation for severe violations of discipline and law. This year, multiple officials from the China Construction Bank have been investigated or punished, including Senior Deputy Manager of its Guangdong branch, Li Huafeng, former Deputy Governor of the Shenzhen branch, Tong Wentao, former manager of the Asset Management Business Center, Li Xiaohong, former senior deputy manager of the Zhejiang branch, who was expelled from the party, and Lao Xinjian, former deputy governor of the Zhejiang branch, who was also expelled. According to incomplete statistics by Securities China, in the first half of this year, at least 21 senior bank executives from state-owned banks, joint stock banks, and policy banks were investigated for suspected violations of discipline and law. Additionally, at least 23 disgraced senior executives were expelled from the party or dismissed from public office in the first half of the year. Although these official reports do not specify the exact violations, given that these incidents occurred within the banking system, it is likely that 80% of the violations were related to financial misconduct. This could involve using their power for personal gain in lending, embezzling public funds, or accepting bribes. The bank's financial resources were already stretched thin due to the economic downturn, and these corrupt officials further drained the bank's funds, leaving even less money available. So, can the Chinese people really protect their money? No one can guarantee that, but it is clear that the money they have in the banks might not be safe anymore.